Guys, I'm going to run Stock Analyzer tool on all 30 companies that I want to own forever. Let's start with Microsoft. I pull up our Stock Analyzer tool, put it in history. Now, a couple caveats. I'm going to show what I think they're worth today based on all three assumptions at a 9% return on desired money. That doesn't include any sort of margin of safety. So whatever price I come up on here doesn't mean it's the price I want to buy it. I still want a little bit better return when buying these companies. So I did Microsoft, 6, 9, and 12% revenue growth for my low, middle, and high, 32, 34, 36 on my profit margin percentage, free cash flow of 28, 31, and 34, PE at the end of 10 years of 17, 20, and 23. Same with price of free cash flow, 9% return. I hit the analyze button. No margin of safety. I have a low price of 170 to 190, high price of 400 to 430, middle price of 260 to 290. So at the current price of 390, I need to be a little patient here. As you can tell, some slacking returns unless we hit the really high assumptions, which I should never buy a company based on the high assumptions. Stock number 2. Google. So again, 5, 8, and 11% revenue growth assumptions, profit margin 22, 24, 26. Same with the free cash flow because they've been pretty consistent. PE 20, 23, and 26, and 9% desired return gives me prices of 110 in the low side, 166 in the middle, 250 on the high. And again, assumes no margin of safety. I have my watch list at 120. Might be a little greedy, but we'll see. Stock number 3, Southwest Airlines. Guys, airlines are tough, but Southwest does a great job managing their business. They keep the same planes. They keep short routes, regional routes. They do a great job. Up until COVID, they've been profitable every single year that they were public. I think even in existence. I love Southwest. It's selling at $28 a share, which is near the COVID lows. I made assumptions of 2, 4, and 6% on revenue growth. Profit margin, my entire thesis is right here. 5-year profit of 6.6% includes negatives for COVID. Before then, they were doing 10 to 15% bottom line profit. So I'm doing 6.5, 9.5, 12.5. Same thing with free cash flow. PE, because it's airlines, I'm going to go a little bit lower, 15, 17, 19. And again, my 9% desired return, hit the analyze button. Green all the way around, 36, 67, 110. I own the company. Don't just buy it because this is all green. Don't buy it just because I have it. Do your own research. The airline industry is tough. Stock number 4, Meta Platforms. This is a company I got very lucky, bought at the absolute bottom, sold too early. Thought the run-up was too quick. I broke a cardinal rule of investing. I sold because it ran up really quickly, and I said there's no way this can continue, and it absolutely did. I regret that decision to this day. I did 5, 8, and 11% revenue growth, profit margin of 24, 28, and 32. Guys, their profit's lower because of the whole Meta investment. It's costing them $10 billion a year. If they just scrap that, look at their profit. Free cash flow, I kept the same free cash flow. Even their cash flow in the last year was greater than his profit margin. PE, 17, 20, 23. Desired return, 9%. Hit the analyze button. I have a low price of 220, middle price of 360, a high price of 576. I have on my watch list at 250. I think I have a sunk cost bias in a way, I guess you'd call it. I think I need to change my my watch list price to 300 because this is still a good company, I believe. And so I'm going to add it at 300 just to take a look at it and see if I want to pull the trigger on it later. All right. Next company, Alibaba. Guys, a lot of fear around China. I read some report the other day that something like not a single money manager in the country is in Chinese stocks. China, there's a lot of political issues with China. Don't get me wrong. There's a lot of fear on this company. Look at it at $70 a share. It hit 58 in the last few years. I still look at the price to free cash flow. I love it. And I think it's the biggest company in the fastest growing economy. I want to be there. And I look at this. I did 3, 6, and 9% revenue growth. I did 15, 19, and 23% profit margin, 17, 22, and 27 free cash flow, PE of 16, 18, and 20, and 9% return. It's at $70 a share. Hit the analyze button. I have a low price of 120 to 135, high price of 333 to 391, a middle price of 200 to 236. Baba is an interesting one. If you don't have the guts to watch this thing fall because of political, you should not own this company. Next company, American Express. American Express is a leader in high-end luxury credit cards. I have one. A lot of people have them. They have the Amex lounges. Great company, 4%, 7%, and 10% revenue growth. Look at the difference between profit and free cash flow. I mean, huge differences. In the last 10 years, they did 14.5% profit, 25.8% free cash flow. So I did my assumptions here. I'm going to base this on the profit margin though, just to be conservative. And I did 9% return. I could probably do a higher PE, to be honest with you. I should be doing 18, 21, and 24. Because this is an amazing company. I'd be floored if they were gone someday. Even on the low multiple of earnings, I don't get this. This company confuses me. I have 185, 339, and 634. I have my watch list at 140 for some odd reason. I think it was because I was buying it below 140 and it went higher, so I set the reminder. But now it's at 180, and I got to decide, am I going to buy it or not? So I buy more shares of it. I do own it. So next company, Apple. We all know Apple. Apple is the biggest guy in the room, 3%, 6%, and 9% revenue growth. Profit margin, 21, 23, 26.5. I did this one to say, what if their subscriptions do better and they start making higher margin than they currently report? Not bad. Increasing return on invested capital. Free cash flow margin, 24, 25.5, 28.5. P of 19, 22, and 26. Same with price of free cash flow. And our 9% return. Hit the analyze button. I have a low price of 90 to 100, high price of 226 to 240, middle price of 140 to 150. I do have it on my watch list at 140 to start selling puts on it below there. All right. And by the way, I believe 140 was Warren Buffett's buy price. I don't know if it's still the case, but just based on the timing of 13Fs and what they were reporting, I think 140 was his price. Next company, Visa, similar to American Express, similar to Mastercard, which we're doing next. I did 5%, 8%, and 13% revenue growth, profit margin. Now here, the profit margin and free cash flow are much closer together. Much, much closer together. So I did basically 50% across the board in some fashion, high of 58%, 18, 21, and 24 in terms of PE and price of free cash flow, and a 9% return across the board. So again, no margin of safety. I have a low of 150 to 160, high of 380 to 415, middle price of 220 to 240. So waiting for it to get there, guys. Next company, Mastercard. Now, Mastercard's a little bit smaller, so I put a little bit higher revenue growth in for Mastercard, 6%, 9%, and 14%. Their profit and free cash flow is not as good as Visa, but still pretty solid, 38 to 46. So on free cash flow, the last 10 years have been pretty similar. The last 5 and 1 year, the free cash flow and profit margin has been different, but I still kept the free cash flow as the same as the profit margin. And then for PE, I did 17, 20, 23, same with price to free cash flow. And again, my 9% no margin of safety return. I have a low price of 200, high price of 560, middle price of 315. This is a big company for Guy Spear. He's owned this for a long time. I think his base is like 30 or 35 bucks, something crazy like that. So good for Guy Spear. Stock number 10, Home Depot. Guys, we all know Home Depot. Them and Lowe's. Lowe's is also on my list. I'll be doing that next. But Home Depot, they're growing worldwide. I have a house in Mexico. That town's got the Home Depot. It's busy. It's flourishing. I like Home Depot. 3%, 5%, and 7% revenue growth. Profit margin, 9.5%, 10.5%, and 11.5%. Same with the free cash flow. I did a PE of 17, 20, and 23. And then my desired return, 9%. Again, hit the analyze button. I got a low price of 240, high price of 480, middle price of 340. So guys, those are the first 10 stocks. Before we go to the next 10, keep in mind, a lot of these have the high price being green. If you remember from 2 years ago, I was never getting that. So things are getting better. Fundamentals are getting better. I'm also understanding what I want more and more about investing. So let's go to the next 10 stocks. All right, next company is Lowe's. Now, Lowe's is like the Home Depot competitor. I love Lowe's. I actually like it a little bit more than Home Depot from a customer service perspective. And my fiance likes them more for more variety of product. But of course, I'm sure it's like Pepsi and Coke. Everybody has their different opinions, and it is what it is. So here on Lowe's, I did 3%, 5%, and 7% revenue growth. Look at these ROIC numbers, just really, really high. Incredible. And Home Depot did as well. Profit margin, I did 5, 6, and 7. I'm actually going to change that a little bit. Actually, no, I'm going to keep it the same because here's where it gets a little tricky. You look at the 10-year profit, you're at 6%. 5 years, 7. 1 year, 8.5. So are they trending up? Or has it been the recent surge in the last 5 years is why this profit margin's been higher? Home Depot's a little more consistent. We'll see. Free cash flow, a lot more consistent here, though, in the 7% range on the 5 and 10 year. So 6, 7, and 8. PE, I put 15, 17.5, and 20. I'm going to change that to 16, 19, and 22. Same with the price of free cash flow. And again, we're doing no margin of safety. I'm assuming a 9% return. What's the company worth to me? It's at $216 a share. We have a low price, 125 to 150. Middle price on the cash flow perspective is there, 190 to 225. High price of 290 to 330. Could you justify it today? Yeah, probably. And remember, guys, all of these returns you put in here, desired returns, include the dividend. All right, McDonald's. Guys, I go to McDonald's every day. I get a sausage burrito and a large Diet Coke light ice. I freaking love it. Call me whatever you want. I still do it. I have like 1 billion McDonald's reward points. So was I a little crazy here when I made my assumptions? 0% revenue growth for 10 years, 2 and 4%? That seems unlikely. Let's go with 2, 3.5, and 5. Okay. Profit margin. Why did I go so low on these? That's interesting. I wonder why. Maybe I was trying to prove a point back then. I was trying to make some point. Let's do 22. Actually, 22 is okay. 25 and 28. Free cash flow margin. Let's do 20, 23 and 26. Maybe 24 and 28. So here I've gone a little bit different, guys. And I'm glad you guys are here watching this because these are some of the decisions you have to make when looking at the numbers here. If there's inconsistencies, what are causing these inconsistencies? That's part of the art of investing, is not knowing what that is. Now for PE, I'm definitely changing my PE. I think what I might have been doing is saying, I'm not desperate to own McDonald's, but I'm going to go 17, 20, and 23. 17, 20, and 23, and then 9% across the board. Stock's currently at 290. I have a low price of 105 to 115, high price of 220, a middle price of 155 to 160. So clearly it's not where I want it to be. So next company is Disney. Now, guys, I do own Disney stock. I'm betting, similar to Southwest, that their profit margin will recover to pre-COVID lows. They have record revenue. It's just been a tough go at lately with all the scandals and everything. Oh, wait, why did I do that? I have Disney already pulled up. So I did 2.5%, 5.5%, and 8.5% revenue growth, which is very aggressive on the high side, if you ask me. I have 6, 12, and 18% profit margin. See, as you can tell, they were at 10% in the last 10 years, including the last 5 years, which are crap. So they have a lot of upside potential, but let's say they can't really break that 6%. I'm going to go low on these profit margin and free cash flow. PE 17, 20, 23, same with price of free cash flow, and a 9% desired return, not including margin of safety. 46 on the low side, 270 on the high side, 130 in the middle. That's why I bought this company. I'm going to add it to my watch list since it's close to 90, at 90. That way it notifies me and tells me, Paul, go buy some more if you'd like. Next company, Adobe, guys. Great company, great software. Very, very diehard people who love this software. A very high, very good return on invested capital, growing. In the last 5 years, they've been at 19.6. Last 10 years, 15. Last year, 22. Subscription-based models are happening with them. Revenue growth, I did 6, 10, and 14. Profit margin, 26, 29, 32. Free cash flow, look at how much higher free cash flow is. Much higher than profit margin. So I'm going with 38, 40, 42. And for my PE, I did 15, 18, and 21 and 9% return. So this one's going to be hard because the free cash flow is a lot higher. So you look over here, based on earnings, 211, discounted cash flow, 300. High side, it works all day, 600 to 800, depending on you're looking at earnings or free cash flow. Middle price of 350 to 500. So I'm just waiting. I have to increase my, that's why. Remember, this is no margin of safety in here. So what discount do I want from these numbers? I think I have to increase my watch list price. Let's increase it to, Let's go to 350. Doesn't mean I'm buying at 350. Just notify me, look at the company again. Has it gotten better, etc. Next company, Nike. So guys, I did 4, 7, and 10%. Now they just lost Tiger Woods. Who knows if that's going to hurt things. But remember, the one thing I'm interested in Nike about is the profit margin and free cash flow. They're doing more direct to consumer, which is going to increase their cash flow, increase their profitability. All right. I did 10 and a quarter, 11, 11 and 3/4. Free cash flow was a little bit lower. If you look at the last 5 and 10 years, it's about 1% lower. So I'm doing 9 and a quarter, 10, 10.75, 17, 20, and 23 for PE and price to free cash flow. And again, my 9% desired return. Analyze button. We're at 65 to 60, 190, 175 to 190, 100 to 110. I want a little margin of safety. Have my watch list at 90. It's getting close to there. Getting real close. All right, next stock is actually a car company, but it's a little bit different, Ferrari. So I'm pulling up Ferrari here. Guys, the great thing about Ferrari is really high gross margin, 50%, really high profit margin. Let's look at what I pulled it up at last time I did it. I did a 20-year analysis on Ferrari. Let's still change it to 10 because I want to focus on 10 years for Ferrari. I did 5, 9, and 13% revenue growth. Profit margin of 18, 19.5, and 21. Free cash flow, here's the issue. Look at the difference between free cash flow and profit margin. Very different, with free cash flow a lot lower. There's a lot of value investors out there who wouldn't even look at this. They'll say, listen, it's not close enough. The free cash flow is too far away from net income. I don't like that. A lot of people don't like that, and I don't like that either, but it's Ferrari. I'm doing 20, 25, and 30 for my price PE and price of free cash flow. Look how much higher this is. Guys, Ferrari to me is an incredible brand. And I'm going to do 9% across the board for my values. I have a low price of 80 to 130, high price of 230 to 400, middle price of 135 to 230. I'm probably going to focus on the free cash flow number here. But one thing I'm going to do before I even look at it, buy it, is why is it so different? Next company is LVMH. We don't have LVMH in our system quite yet. It's coming sometime this year, early next year. But it's Louis Vuitton. High-end brands. Love the fact they don't discount anything. They got a lot of brands under them. I love it. Next company, Rowe Price. All right, guys, with Rowe, you got to look at it. They manage money. So if the market's going to go sideways for a while, it's going to be hard to grow. I did 0, 3, and 6% revenue growth. Profit margin, I did 24, 28, and 32. Significantly lower than their last 5 and 10 years, but we've been in a booming market. So I assume it's easier to make money. Free cash flow, I did 22, 26, and 30. 15, 17, 19 on PE. And again, we have to change our desired return to 9% across the board for what I determine intrinsic value to be. We have a low price of 76 to 83, a high price of 190 to 200, middle price of 120 to 130. It's currently my watch list at $93. Is 105 a reasonable enough discount to 120? I don't know. Next company, Sherwin-Williams, Cleveland's own Sherwin-Williams. So guys, in Sherwin-Williams, I might have been a little aggressive on the revenue growth percentage, but I was looking at the world, saying the world's doing more, getting better economically. They tend to build more. 4, 7, and 10% revenue growth. Profit margin, I did 8.5, 9, 9.5. Free cash flow, I went a little bit higher because historically in the last 5 or 10 years, they've had better free cash flow than profit margin. So I did 9.5, 10, 10.5. PE, 15, 16, 17. I'm actually going to change that. I'm going to do 15, 18, 21. And 9% across the board. We have a low price of 140 to 150, high price of 390 to 430, middle price of 226 to 250. It's on my watch list at 150 for my margin of safety in there. Might have to be a little bit higher. Maybe I'm going to go 175 here. Give me ample margin of safety, but I haven't looked at it in a while, so that's probably why it's different. The last of this batch of 10, Generac. Guys, Generac is an incredible business. They lead in terms of generators. I have a Generac generator at my house. The last time we did it, here were my assumptions, but I love Generac because it's under the radar. You don't hear anybody talking about it. Nobody brags about Generac. Like, oh, you got a Generac generator? But they make good money. This stock was at $500 a share a few years ago. It's at $113 now. I bought it at 83. It skyrocketed to freaking 125. I was only able to buy one tranche of my buying, but let's look at 3, 6, and 9% revenue growth. 9.5, 10 and a quarter, 11 profit margin. Free cash flow, I don't know why I did so much different because the last 10 years it's been pretty consistent. So maybe I'll increase this just a smidge. 8.5, 9.5, 10.5, 15, 18, 21, 15, 18, 21. Analyze it. 9% return. 85 to 95, 203 to 213, middle assumption of 130 to 140. Could you justify it here? Sure, I have my watch list at 90. I think I'm going to change that to 95 now. Actually, I'll change it to 100. And the reason being, that's ample margin of safety where I can start selling puts at a lower price. So that's the second batch of 10. One more batch to go, guys. We're going to check it out right now. All right, guys, our last batch of 10 stocks. Number 21, Starbucks. We all love Starbucks. I said in a video, the world's most legalized drug. Here's where I did my analysis. 5, 7.5, and 10% revenue growth. Profit margin, 10, 11, 12. Free cash flow, same thing. I did a PE of 17.5, 20, 22.5, and again, our 9% return. I hit the analyze button, and I have a price on the low side of 61, high side of 128, middle price of 88. Again, no margin of safety. I have it on my watch list at 80 to start selling puts at lower prices. All right. Stock number, the second stock of our batch, Otis. Some of you might not recognize this name. And next time you get an elevator, look at who the elevator is made by. It's probably Otis. There's one of 3 companies. Otis is the leader. I learned about this company through owning apartments that had Otis elevators. I'm going to tell you right now, 15 years ago, the hourly rate for an elevator mechanic was like $250 an hour. I can't even imagine what it is today. There's only a few players in the game, and it's very hard to get them to come out. 2.5, 5, 7.5% revenue growth. Margin, 7, 8, 9. Free cash flow, 9, 10, 11. They haven't been public as long as other companies, but I like the business model. As long as we build apartments, we're going to have these kind of things, office buildings. PE, I did 17 across the board. Just because it's a newer company, I did 9% return. The stock's currently at 86. Based on our assumptions, low price of 38 to 48, high price of 70 to 86, middle price of 52 to 65. I have my watch list at 45. I'm actually going to change that to 50. Again, no margin of safety in here. And this is the price for Notify Me so I can take a deeper look, not necessarily the price I'm going to buy it at. All right, next one, Pool Corp. Guys, they do exactly what you think they do. I did 3, 5, and 7% revenue growth here. All right, margin, I did 5, 7, and 9. I think I was just being a little dramatic there. I'm going to actually change that now. It must have been based on past data because I hadn't done this analysis in a long time, which is great for why we have this watch list and the software so I can go in here and change my assumptions. I'm going to do 7, 9, and 11. Free cash flow, I'm going to do the exact same thing. PE, I'm going to go 14, 16, and 18 because it's not a sexy company. It does have high returns on invested capital, but I think my price is a little low here based on my changing assumptions. My low price is now 150. My high price is 370. Middle price of 240. I'm going to put this strike price, since it doesn't include margin of safety, at 225. So I've really increased it. And this is one of the benefits of keeping everything in your software here. That way it keeps a track record of everything I did in the past. I can sit there and say, why did I make that assumption? So now I can go back and check that out. All right, the fourth company on this batch of 5, Costco. Guys, Costco is all over the place being discussed. Why? Because Charlie Munger talked about how amazing it is. Every Charlie Munger wannabe on Twitter that I see talks about how Costco is the greatest company ever. Frankly, guys, I just think it's overpriced. It's at $683 a share. I made assumptions of 3, 5, and 7% revenue growth. Probably low, but 2.5% margin, pretty consistent across the board. Same with free cash flow. I did 18, 20, and 22 PE. Should I go higher? Should I go lower? I don't know. That's the art of investing. 9% returns. 235 low side, 366 high side, 293 in the middle. I'm going to change my watch list price to 275. Actually, I'm going to do 290. But again, not to buy it there, to set my reminder so I can either start selling puts or do more research. Fifth company today, Target. God, this thing fell a lot recently. I don't think Target's going anywhere. I think they're doing a great job for women. Women love going there. Revenue's going up. They're closing locations that weren't doing as well. I did 2.5%, 4%, and 5.5% revenue growth. Profit margin 3.25%, 4%, 4.25%. Free cash flow 3.25%, 4%, 4.75%. PE of 15, 17.5, and 20. Same with the price of free cash flow. And again, our no margin of safety, 9% return. Analyze button. Kind of makes sense at this price if you want a 9% return. Based on this, you'll make about 12% based on 136. Guys, I was buying it below 135, so I'm actually going to add it back to my watch list at 135. I started buying actually a little bit higher than that. I started buying it higher than 135, but I was buying it all the way down close to 100. My basis is really good, but again, I'm really trying to fight that urge of saying, oh, I got such a good deal. Do I really want to pay more for it? If it's still a good deal at 135, I got to buy it at 135. So again, do your own research on this one. The sixth company, TJ Maxx, another haven for the women. They love it. And I think TJ Maxx is sticking around because they do all the closeouts. It's hard to do that on the internet. It's hard to sell those things on the internet. I did 3%, 5%, and 7%. Look how consistent their revenue growth rates were over 1, 5, and 10 years. Profit margin, I did 6.25%, 6.75%, 7.25%. For free cash flow, they had higher free cash flow in the last one. Actually, you know what? I'm going to change that. I'm going to go exactly back to what it was above. So I'm going to change that right here. 6.25, 6.75, 7.25. PE of 14, 16, 18. Having on my watch list at 50. Low price of 42, high price of 76. 56 is my middle. I love the fact that I have my watch list at 50 so I can start selling some puts at lower prices. Okay. Next stock, Sprouts Farmers Market. Guys, this one has skyrocketed on me. It's $51 a share. I like this company. Very niche, growing, higher margin than most grocery stores. I did 3%, 5%, and 7% revenue growth. That could actually be very, very low. I mean, they're growing at much faster rates with a lot more growth potential to come. Profit margin, higher profit margin than like growth, like Kroger's like 2% or 1.5%. Free cash flow, even better in the last 5 years. PE 14, 16, 18. Same for the price to free cash flow. And my desired return, 9%. You should probably have a higher desired return for your minimum there. And you might sit there and go, well, Paul, it's actually not, well, my price was not this high. 31 on the low side, 68 on the high side. My price is, I have it on my watch list for sub 40, and I like that price for it. Sub 40, I'm interested in it at sub 40. That's where I stand on it. Next company, Cintas, the uniform people. They do a lot more things, but they're called the uniform people for a reason. Cincinnati, Ohio, flies under the radar, not a sexy business, but a growing return on invested capital. That's what I like. Revenue growth, I did 3%, 6%, and 9%. Profit margin, 13, 14, 15. Same with the free cash flow. I kept it the same because in the last 10 years, free cash flow was a little bit lower. Last 5 years, a little bit higher. So I just decided to keep it the same. PE, 16, 19, 22. Same with the price of free cash flow, 9% return. Hit the analyze button. The stock's currently at $590 a share. Guys, look at this. I have 185 low end, 414 high end, 276 in the middle. I want to start selling puts sub 270, probably much lower than that, but I have it on my watch list for 270. My last two companies, before we get there, guys, you've seen me showcase the software, the tools here, how awesome it is. I encourage you to take advantage. If you've made it this far in this video, it means you're serious about investing. Take advantage of our free trial, 7-day free trial at everythingmoney.com. Everything here, all the tools, all the community, all available for 7 days for free. So go check it out. And our last two companies, Brookfield Asset Management and Berkshire Hathaway. Guys, unfortunately, Stock Analyzer tool doesn't work quite as well for those companies, so I'm not doing those. But if you watch our channel, subscribe to us, you will learn how I value those companies. Thank you for your time.